Well, good morning, everybody. Thank you once again for joining me today. It's April 22nd, 11 o'clock in the morning here in Long Island. As you can see from the window here, I've got quite a bit of sunshine, so it's nice. I mean, we've had a lot of rain here ever since the winter. We didn't have much, we didn't really have any snow. And but April hasn't been too bad rain-wise, but we have some. And what they say, April showers bring May flowers. And then I think they say something like you're supposed to go away in May. So maybe this time around we were supposed to go away at the end of March. I've always had a problem with that go away in May and then come back sometime in October, is that you have to make two good calls. You have to make a call that May is actually a peak for the year, or at least it's an opportunity to cash in some chips and not see the market go down through the summer into the fall. The problem is that very often May has been a good month to get out of town, get out of Dodge, but sometimes it's been July when you wanted to get back. Sometimes it's been October. October does tend to have a history of being a good month for setting us up for buying opportunities, which means that sets us up. September and October we see the market go down, and then we have the opportunity. But playing the market timing game is a tough game. We've had a few good calls in terms of pointing out peaks, but we've actually done better at calling bottoms. So we'll continue to. There's always interest in that, and everybody always wants to know whether the next correction is the beginning of the end of the world, or at least it's the beginning of a bear market because the economy is turning sour. I think we're in a bit of a correction right now. I think that we did reach an all-time high clearly on March 28th. We're down as of Friday by 5.5%, not exactly the end of the world. However, some of the gamier areas of the market are down more than that. Technology certainly is down more than that. Some of the higher beta areas. But all in all, so far so good. I think last I looked, the market was up a little bit, and that's because oil was down a little bit. So I guess any weekend where missiles aren't being launched between Israel and Iran is a good weekend. So the markets are relatively happy with that. It all does suggest that there has been something like a $4 or $5 geopolitical premium in the price of oil, and that seems to have come out of the price. It also indicates that the global economy isn't all that red hot. That once you take out the premium, that it's not as though this oil price went up to $91, $92 a barrel a few weeks ago, 3 weeks ago, on the global economy doing better. It clearly coincided with the geopolitical situation in the Middle East continuing to deteriorate. I guess the markets are now sort of discounting the possibility that the Middle East will be background noise again. Speaking about background noise again, somebody came to visit us here. So the Middle East situation remains volatile, remains dangerous. And by the way, it's not just that. It's also Ukraine and Russia. The Ukrainians have taken the war to Russia with drones hitting their petroleum refining facilities. And now with the passage of more money, providing more ammo to the Ukrainians, things are going to heat up again. The Ukrainians aren't going to be on the run anymore, and they're going to be taking the offensive position more and continuing to bring the war home to the Russians. And the geopolitical consequences could possibly be felt in the price of oil. Look, we're still sort of in this upward rising channel in the oil price. I've shown you that channel before. And it does suggest that we're about to test or go back towards testing the bottom of that channel. But we'll see how well things remain to the downside. But look, I don't want the price of oil to go up. I'm rooting for peace in the Middle East, or at least calm in the Middle East. Certainly not rooting for any of the escalation that we've seen over the past few weeks, and that should help the market clearly, especially if oil prices don't go up. It also would help on the inflation front. So what is there to worry about? Well, there's a small matter of the Fed coming around to a view we've had that there's no particular reason to rush or to even think about lowering interest rates if, in fact, the inflation rate continues to moderate and if the economy remains strong. Well, our main argument has been a strong economy with low inflation doesn't require interest rates to go down. The argument that's been making having an impact on the market isn't just that the economy is doing better than expected, but it's also based on the notion that inflation was hotter than expected over the past 3 months. And as we've seen, the Fed has backed off and perpetuated the notion that there's no rush for the Fed to lower rates, and that the evidence they've gotten for the past three months does not give them the confidence to be moving towards lowering interest rates. Well, I think it'll be interesting to see what happens on Friday. Friday, we're going to have the personal consumption expenditure deflator. It looks like it could be, well, it's got to be lower than the CPI. CPI has some factors that cause it to be inflated relative to the PCED. I pointed that out before. If you take the average spread between the CPI core and the PCED core, and you might as well do it with core because we know that food and energy indexes are more or less identical in the PCED and the CPI. So you look at the core, over time, that spread has averaged 0.5 percentage points. So that obviously can matter. And the reason for the discrepancy has been things like health insurance. There's a really funky indicator for health insurance in the CPI, much less so in the PCED. So the PCED rate tends to be much calmer, whereas the CPI health insurance, CPI tends to be very volatile, extremely volatile, just kind of crazy volatile. We'll look at that in a minute. And then a motor vehicle insurance has been going up. It dawned on me that the reason for that is, if you drive around town or on the highways and you look at the cars, or just parking lots, most of the cars are SUVs. They're these big trucks, and they're not cheap, and they cost a lot of money to maintain, and they cost a lot of money to repair. And so some of this inflation has to do with the fact that people have the wherewithal to buy these cars, even with auto rates going up. Another area has been hospital inflation in the CPI exceeds what it is in the PCED. And that's because in the CPI, it's out-of-pocket costs that are calculated. So it's kind of what you pay when you check into a hospital, what you have to pay for. Whereas in the PCED, it includes the fact that the government or insurance policies pick up a big part of the tab. And that's not reflected in the CPI. It is reflected in the PCED. So I'm about to show you that I'm sticking to the notion that inflation's continuing to moderate, that 2% inflation by the end of the year is very realistic. And if we get a number that sort of raises some doubt about how hot inflation is, as indicated by the CPI, if things look a little cooler in the PCED, that should help the market. Earnings this week should be another big week. Should be a big week for earnings, and that may help out the market. But the big issue is, of course, interest rates are still high. Maybe the cooler PCED will help to cool them off. I think the big issue is simply technical. There's been too much bullishness. Put-call ratio remains relatively quiescent. I think there was one day last week where it took a jump to the upside, but came down rather quickly. And maybe all we simply need to do is just kind of have a little time here for earnings to catch up, so that we don't continue to have a PE-led melt up. And so maybe that's the transition we're seeing here. Is we're going from a PE-led melt up to an earnings bull market. In that kind of scenario, I could see the market just kind of pausing for a while. From a technical perspective, the downside in the market could vary. There still could be some downside here to 4,800. Not that far down from here. 4,800 is sort of the you can draw a horizontal line going back to where we were in the peak of what was it, January 3rd, 2022. So that would mean that the market basically hasn't gone up at all since then, though within that, obviously, there's a lot of dynamics. The other place that could find some support is in the 200-day moving average, and that's closer to 4,700. But now that I've said all that, it's probably not going to happen at all, and the market will just kind of hold its own for a while. Still looking for 5,400 by the end of the year. Let's go to the videotape. Let's go look at, thanks for the nice turnout here. We appreciate that all you folks were able to take some time off this morning to join me. So let's go look at the charts right here. So this is the chart collection for April 22nd. That's today. We do send out an advanced copy. Sometimes the Monday pieces tend to be, I don't know if, I don't want to call it long-winded, but they're longer and they're more detailed. And so, for those of you who'd like to have some time to actually look at these things carefully, we do try to provide that information. So, and give it to you ahead of time. So here's figure one. It shows you this CPI headline. Let me just make it a little even bigger because there's a lot going on here. We do like to keep our charts simple. As you can see, we don't have a lot going on in the charts other than one or two or sometimes a few more series. But I hope you like the new look. It's been much easier for us to work with it and to come up with some theses and then test them real quick. Can even do it by myself now. So here's the CPI. Terrible, 3.5%. It's stalled out here. Oh my gosh, it's stalled. It's sticky, whatever you want to call it. This is the CPI less shelter. It's sticky all the way down here around 2%. It got down below 2%. It's volatile. I mean, that's the way it is. But the reality is, excluding shelter, the CPI headline is 2.3%. There's a two handle on there, and that's pretty close to the Fed's official target. Of course, their official target is PCED, and keep in mind, as I just mentioned, PCED inflation tends to be less hot, tends to be cooler than CPI. Now let's look at the core. Again, food and energy tend to be identical in the CPI and PCED. So let's drill down a little bit here. So we're looking at the core here, and you can see that the core inflation rate, oh my gosh, is 3.8%. Look at that. It stalled just a little bit there. What a disaster. Well, let's look at the core CPI less shelter. I'm being sarcastic, obviously. Core CPI less shelter. You can see we're all the way down to 2.4%. We did get down to 2%. We bounced off of that. Oh my God, inflation's going to go back up, and so on and so forth. I think you got Larry Summers once again taking a very contrary perspective that inflation is going to make a comeback and the Fed's going to have to raise interest rates. Jamie Dimon's in that camp talking about much higher interest rates. We're not for now. We're open-minded, but from what we see, we don't buy that scenario. So here's the headline and core, both of them in the same. We just looked at them in two different charts, comparing them to the CPI overall. Let's look at the CPI less shelter versus the CPI core less shelter. And again, same numbers as we saw before, 2.3, 2.4. Doesn't look too bad in my opinion, unless you're looking for trouble. Put a magnifying glass there, and obviously you can find something to worry about. But look at the handles at 2, and below 2.5. That's pretty good. So shelter is a big source of the problem, and shelter is taking its sweet time coming down, but it is coming down on a year-over-year basis. CPI rent of shelter is available through the early 1990s, and you can see we had the same situation. Well, I don't know that you can really compare this to anything that happened back here. This was the great financial debacle, and housing took a dive in the whole thing, but it is coming down. Let's take a a closer look at this. This is the two components of important components of CPI shelter. It actually has three components. It's got rent of primary residence, tenant rent. It's got owner's equivalent rent, as you can see, and it's got lodging, which is basically hotels, motels, dormitory. So that's where you're just not staying at home, either in a rental or something that you own. So look, I don't really want to get into the OER right now. We all know it's a funky, weird kind of concept, but it's a important concept because it's a big part of the CPI. But as you can see, especially of late, it's been correlating really well with the tenant rent, which suggests that whatever methodology they're using to come up with OER, at the end of the day, it's pretty much reflecting what tenant rent is. OER, as you know, is what you would have to pay yourself if you were your own landlord. I mean, that's the kind of concept it is. It is what it is. But everybody knows that it's funky, but we still look at it, obviously. And we certainly look at tenant rent because that obviously is relevant. It's, I just, as a homeowner, I just don't feel the concept of OER in my family budgeting. So here we got a new rent index, by the way, that the Bureau of Labor Statistics came up with. And I guess they had enough people kind of questioning what's going on here with rent, because we all know that the CPI rent of primary residence reflects all open leases, not the latest, newest leases. So the BLS came up with the concept of new tenant rent and all tenant rents. All tenant rent includes the leases that are currently in force plus new leases. This is just the new leases. And you can see here that sure enough, they really didn't reinvent the wheel here. The CPI rent of primary residence correlates very closely, tracks very closely to the all tenant rent concept. So there's not much new there. I guess what is new is there's now an official measure of current new leases of new tenant rent. And you can see, oh my God, that's down to 0.4%. Before you know it, we're going to be worrying about deflation in the rental market. Clearly, there was a big problem back here. With the benefit of hindsight, if we just took, we have to be symmetrical about it. And if now I'm going to tell you that new tenant rent makes more sense than the all tenant rent, which has been a point that a lot of people have been making, and I agree with it, then back here, inflation was, in fact, much higher. Well, what does 0.4 mean here? First of all, let's look at the 0.4 relative to Zillow. Zillow has a rent index, and that's actually still pretty hot at 3.7%. And oh my God, it's worrisome. It's going up. Then on the other hand, we've got the apartment list rent inflation, which is actually deflating still. So pick your poison here. I guess I'm going to go with the official one of 0.4 as the current rent inflation rate, which is awfully low. I just saw somebody walking by here. So let's look at this. This is the official CPI rent of shelter. Includes tenant rent, includes OER. And this is the rent of shelter just for new leases, and that's down to 0.4. So what would the CPI look like instead of looking like 2.4%? What would it look like if we use the new tenant rent as opposed to that? And the answer is that it would be something like 1.6%. So in other words, we're already really below 2% using this particular measure of shelter. So before I looked at the CPI core and headline excluding shelter, now I'm saying, okay, let's try to put in what makes sense, which is the one that reflects current leases, and the answer is something south of 2%. So that means that over time here, as the all tenant rent component that the BLS shows you, this is the new tenant rent. This is the CPI. This CPI is basically the all tenant rent component. That's going to be continuing to come down, and so I think by the end of the year we got inflation at 2%. Of course, that assumes that nothing else goes wacky. I have been concerned about the price of oil, but it looks like it's going to calm down, and that there's plenty of oil out there. Let's take a deeper dive into the housing market, just for fun, since we're talking about housing. This shows you the little dots are the number of households in America. They have to live somewhere, so there's something called total occupied housing, and that's 131.2 million. And then there's owner occupied and renter. So we have that data, and it's available quarterly. Then just so we put it in perspective, we can see that actually going back to 1965, home ownership has been relatively stable around 65%, 65%, 66%. And then the renters as average has been 34%. So that's just out of curiosity, out of interest. As you can see, during the pandemic, people rushed out of rentals, went to buy homes, and then they, I guess, got bored with Green Acres are the place to be for some of you who remember that 1960s or 70s show. Anyways, they decided they didn't want to live out in the sticks, so they started moving back into rentals, I guess. But this was clearly pandemic related. It did have an impact on rents, of course. But here's the thing. We actually have quarterly data on who owns houses by generations and how much wealth they have in there. And as you can see, this is the total wealth, which just value of residential real estate. And from about this point here is looks like it's about 2011 or so, 2012. We've more than doubled. We've gone from a little under $20 trillion to $45 trillion. So huge increase in the value of homes. A lot of that increase has been enjoyed by the baby boomers. They've had a big increase in the value of their homes, as well as Gen Xers. The millennials are struggling to get into the housing market, and they don't own as many houses. But over time, the generational thing changes. I've quoted Spock often, Spock from Star Trek, live long and prosper. If you live long and you do some saving along the way and accumulate a portfolio of different assets, you're probably going to be quite well off by the time you get to retirement. Not everybody's like that, obviously, but there's a lot of baby boomers, and a lot of them have done quite well. Notice that mortgage borrowing has been flat to down really over this entire period, where we just saw this tremendous increase in real estate values. And look at the baby boomers. The baby boomers, this is what their mortgage obligations are. They've been paying off their mortgages. They've been coming down. Meanwhile, the Gen Xers who've been kind of buying some of those houses, their mortgages have gone up. The millennials have been struggling to buy houses, and they've got to borrow money to do that. And I think some of that money has been coming from mom and dad, baby boomers, and Gen X's. I know that from personal experience. So here's the bottom line of it is really pretty impressive. This is owner's equivalent, owner's equity in real estate, household equity by generations. And you can see that the total has gone up dramatically. And that's because the home prices have gone up and the mortgages have been flat. For the baby boomers, the real estate value has gone up and the mortgages have gone down. So a lot of them have paid off their mortgages. It's quite that simple. And so as you can see, we're, I don't know, what is this point here? It's below 5 trillion. I'm more scientific in the morning briefing, but I can't remember all these numbers anymore. I don't know that I ever could, but anyways, you can see there's been more than a doubling in the equity value that baby boomers have in their houses. The Gen X's have done pretty well, and of course the millennials are behind. So there's what's the point of all this? Well, the baby boomers and the Gen X's have a lot of capital gains in their homes, and so maybe that's another reason not to sell a house, because then you have to pay a capital gain on it. If you're an older senior baby boomer, maybe you start to think about, well, tax purposes, I'll just leave it as part of the estate or leave it to the animal shelter if you didn't get along with your kids or don't have any kids. So there really has been a shortage of inventory. People are staying put in their houses, even large houses that from some articles I've been reading, baby boomers are staying put. We have a relatively large house. I have a home office. My wife has a home office. And every now and then the relatives come stay over, and we got all these dogs. So I'm an example of a baby boomer who's got no interest in downsizing. We're still using our space here for family, personal reasons, and for business reasons. Of course, other people have just recently found the joys of working for homes. Well, it can be joyful. It could also be a little challenging, as you might have seen last week when I had all the dogs kind of running around, got me a little bit discombobulated. But all of this means that the supply of new housing, this is new and existing homes for sale. You can see that they've popped up a little bit, but they remain extremely low. So there's a real shortage of new and existing homes. This shows you the month's supply of new and existing homes, well below previous historical positions. I mean, there's an upturn here, but still a real shortage of homes. So as a result, shortage of homes, even though mortgage rates have gone up, maybe mom and dad paying the down payments and helping with the mortgage payments, you can see that home prices have gone up quite dramatically. This is the home prices for single-family homes, and you can see they're up to $402,000. That's more than a double from back here. So the housing affordability is down, but I think this is missing the fact about some intergenerational transfers of funding to help the kids buy a home. And finally, let me note that what does all of this mean for rent? A lot of people need to live someplace. If a lot of people can't afford to buy a house because they don't necessarily have help from mom and dad, then what do? Well, they're forced to rent. So if there are all these people that are forced to rent that would have preferred to buy a house, it wouldn't that send rents up? And it did. But you can also see in the red line here, this is multifamily housing completions. And what you can see is that the 3-month average, because it's volatile, is the highest it's been since the late second half of the 1980s. So we've got a lot of construction that's of multifamilies that's being completed. Some of you who live down in the South, I'm sure you can see these things going up and getting completed and now being opened up to renters. And I think we may very well see a situation where the supply of rental apartments in the areas where people want to live, which, migration-wise, we're seeing more people moving down to the Sun Belt. That may take some of the pressure off of rent inflation as well. So bottom line is, I think rent inflation is coming down. I can't tell you what's going on the geopolitical scene. Can't predict it, but looks like both sides don't want the Middle East war to escalate from here. The war between Ukraine and Russia undoubtedly will escalate from here. Price of oil looks pretty calm right now. Price of copper may be telling us that the global economy is picking up, but I lean towards the thesis that it's actually a sign of more deflation. Because copper going up, in my mind, means that the Chinese have decided to ramp up their production of solar cells, electric vehicles, and so on, and dump it into global markets. That's why Janet Yellen went over there. They will basically ask them not to dump, but they're not going to listen. And I guess we can see that in copper. So the price of copper going up is not necessarily a sign that the global economy is doing better. Chinese manufacturing is doing better, but it's producing excess capacity. Let me take a couple of questions here. I think I need to have a drink of water. If the rent index is flawed and rates are held steady, is there a possibility that holding rates steady for too long under a flawed inflation reading could double the rate reductions to 2025 to avoid an increase. Look, I think what the Fed's doing right now is keeping mortgage rates up. That's probably going to do some depressing of housing activity, and it could very well mean that more would-be home buyers are going to rent instead. And in that scenario, that could heat up rent inflation. But as we just went through, it's a lot of moving parts here in the housing market. And my conclusion is that supply and demand in the rental market will probably equilibrate in such a way that rent inflation is going to continue to moderate. Hey, Bob, does all tenant rent include, that's the BLS number we just looked at, does all tenant rent include renewals of existing leases? Yes, it does. And if so, isn't that as important as new tenant rent from an overall tenant lease inflation rate? Well, the all tenant rent includes new leases and currently open leases, active leases, effective leases, whereas the new tenant is just those new leases. And I think when they're talking about new leases, that it's the new leases wouldn't, in fact, include renewals, because obviously the new leases, many of them, most of them, all of them are going to reflect an increase in rent. Or if the market gets competitive enough, maybe no increase in rent. But yeah, I think the new tenant rent includes both whatever leases are being signed effective and on a current basis. Chip, considering the historical relationship between small cap and mid cap stocks versus current large caps and economic cycles, how do you foresee these segments performing in the coming years? Hey, I've been terrible in that area. I've been waiting for the mid caps to start to outperform for a while. They did it again earlier this year. I think now they're not doing it quite as much. They certainly look cheap. I think for the past couple of years, the problem has been this widely expected recession, the most widely expected recession of all times that never happened. I think that was weighing on the mid caps relative to the large caps. We know about the mega cap 8 or magnificent 7, whatever you want to call them, that they've dominated the large caps and kind of sucked all the air out of the room, certainly for mid caps. I guess the other problem is that the private equity folks have been buying a lot of companies before they even think about going public. So maybe there's a shortage of really exciting high flyers because those get picked up by the private equity. But it is a bit of a conundrum. They do look pretty attractive still. I think the other part of it, of course, is the indexes have been held down. The mid caps have been held down by the banks ever since we had the crisis, the mini banking crisis last year in March. Okay, let's call it a day. Thanks everybody for joining. Appreciate your attendance. All the best.